Hey, I hope everybody is doing well. Happy 4th of July to you all. I have a few things that I want to cover today, and one's a stock everybody's been asking me about. One's something heavier that I need to tell you my thoughts on, and the last is the bigger macro story that ties right back into the gold and silver position we've been building for quite some time. Let's start with SpaceX, since a lot of you, and I mean a lot of you, reached out about it. When a stock has a debut this hot, my instinct is always to wait and watch the first move play out before getting involved. And SpaceX is actually a great real-time example of why. It priced at 135, opened around 150, and within days spiked above 225. It was one of the most chased IPO debuts I've seen in years, maybe my whole career. Retail investors piled in harder than almost anything I've ever seen in the dot-com era. In the first 3 days alone, retail bought more SpaceX than Nvidia, Google, Amazon, Microsoft, Meta, and the S&P and the NASDAQ 100 combined. That tells you this wasn't really investing in the early days, it was just pure excitement. And the excitement, like that, almost always cools off. The stock has since round-tripped most of that move back down to where it opened. The average person who bought in after the IPO is actually down, the average person. This is the exact pattern I try to help you watch for. Letting the emotion of a hot debut settle before deciding whether it's actually a fit for your portfolio. There are a few other things that I won't bore you with, like the float. The float is the amount of shares available to purchase versus the amount of shares held by insiders. I guess I am boring you with it. And there's something else worth knowing. If you still want exposure down the road, SpaceX floated only 5% of its total shares at the IPO, 5%. That's a big reason of why it went up so hard. There simply weren't that many shares available, and I knew this. But that also means there's a wall of supply coming. Next summer, between June and July, the insider lockup eligibility expires and nearly 97% of shares are available to sell within a matter of weeks. So we're not against this company, we're against the bad entry. Timing still matters. Now in regard to the war. I wish I had better news, and you guys probably know what I'm going to say. I'll be the first to say I really hope I'm wrong. I think things are going to get a lot worse. There's really been no ceasefire. I'm not sure if that means Russia and Ukraine are going to heat up. In Europe, yes, I said Europe. I don't know if China and Taiwan is actually on the table, or if it's Iran-Israel-U.S. It could be all three. I'm not saying it is. How would I know this? Well, I asked myself that same question. The honest answer is I really don't know for sure. But based on a slew of economic models I use, it looks like a massive amount of volatility is about to hit the markets in this month. In any event, I am preparing for a bigger conflagration. I've already been raising cash over the last month to decrease our risk. Now let's talk about the bigger picture, because this next part is really the heart of today's update, and it actually connects to what I just said. We've talked before about metals, gold and silver, many times, specifically about why we believe they would move higher and why we couldn't also run it up in a straight line. Silver in particular got ahead of itself. It moved up faster than the physical industry could actually keep up with the demand. The refiners couldn't process and deliver the metal back to the market. And when that happens, you get a mechanical pause. Not a change in thesis, just the market catching a breath while supply catches up to demand. Then we get a second variable nobody was pricing in, interest rates. 10 months ago, the market was pricing in 6 rate cuts, which is really good for the market in terms of liquidity, free money. Today, that same market is pricing in 2 rate hikes. That is the fastest reversal in Fed expectations I've seen in my whole career. Lower rates are usually rocket fuel for metals, and that fuel got pulled off the table almost overnight. So between the refining bottleneck in silver and the rate story flipping on its head, and now this geopolitical risk building into July, that's exactly why we've seen this pause and pullback, and exactly why we're staying defensive in some areas while staying confident in others. None of this surprises us. We've talked about the refining constraint before it happened. The rate move, while abrupt, in my view, temporary, and metals tend to do very well when geopolitical risk rises, not poorly. The macro backdrop that has got us into metals in the first place hasn't changed. If anything, it's still building. I remain genuinely excited about how this plays out from here, even with the caution I just walked you through. We positioned early, we expected turbulence along the way, and now we're seeing exactly that turbulence for exactly the reasons we expected. That's not a reason to panic, that's a confirmation the process is working. As always, if you want to talk through any of these in more detail, your specific positioning, what we're watching, or you just want to talk it through, please reach out to me anytime. That's what we're here for. And please pass this on. I don't market anymore. I know what I'm talking about here. This video is going to age well. And if you have any friends that, want to hear some good advice about gold and silver and watching out for the market, likely seeing oil go higher here into the future, go ahead and send them the video. But again, none of this is investment advice to anybody that I am not an advisor for. Thanks for listening.